Good morning. Have you ever wished you could put away more money into a Roth account that the IRS usually allows? Well, the Mega Backdoor Roth 401k may be the ultimate strategy for high savers, but is it really worth it for you? Stay tuned because the answer could change how you save for retirement. Here's the challenge. Roth IRAs have low contribution limits, just $7,000 in 2025 if you are under age 50. Even Roth 401ks have limits. But if you could funnel up to tens of thousands of extra dollars into a Roth each year, tax-free growth, no required minimum distributions, and more flexibility, that's exactly what the Mega Backdoor Roth allows. If your plan supports it, not all 401k plans support the Mega Backdoor Roth strategy. However, a plan from my solo 401k financial, known as a self-directed solo 401k plan, does allow for the Mega Backdoor Roth solo 401k strategy, and we will be talking about that today. So most people don't even realize that this strategy exists. And many who do think it's only for the ultra wealthy. But the truth is, if you are self-employed or have access to the right kind of 401k, you might unlock up to $70,000 per year in Roth contributions effective for tax year 2025. Imagine the tax-free growth potential on that. Now, not all 401ks, as I mentioned earlier, provide the Mega Backdoor Roth 401k strategy. For example, traditional 401k plans offered by full-time employers do not always allow for the Mega Backdoor Roth 401k strategy. I know that the Amazon 401k plan does, because we've had many former employees of Amazon transfer their 401k to a self-directed solo 401k with my solo 401k financial, either because they were downsized or because they decided to move on and become self-employed. So whether or not your daytime employer 401k allows for the Mega Backdoor Roth 401k depends on that employer's 401k. That employer, in other words, can choose whether or not to allow for the Mega Backdoor Roth 401k strategy in their plan. The good news is that with the self-directed solo 401k, you are the business owner. So you can decide whether or not you want the plan to permit the Mega Backdoor Roth solo 401k strategy. Second, you need to make sure that the solo 401k plan provider that you use can provide a plan document where you can elect for the Mega Backdoor Roth solo 401k strategy. And again, a solo 401k plan from my solo 401k financial does allow for the Mega Backdoor Roth solo 401k strategy. So if you are self-employed and looking to open a self-directed solo 401k, it's good to know that a plan from my solo 401k financial is automatically drafted to allow for the Mega Backdoor Roth solo 401k strategy. Therefore, you don't have to worry about it not being available. And because the plan is drafted for the maximum flexibility under the law, it's also drafted with the auto contribution credit of $1,500, where the government is essentially subsidizing the cost of having a self-directed solo 401k for close to 7 or 8 years when you open that type of plan with my solo 401k financial. All right, as always, please like today's video. Please subscribe to our channel so that you receive more notifications when we go live. It also helps to get the word out to other solopreneurs like yourself. Go ahead and also type over any questions you have during the live chat, and we'll pause and answer those questions as they come in. And then looks like we actually have some questions here. And again, it doesn't have to be surrounding today's topic specifically. It can be surrounding any aspect of solo 401k plans and even self-directed IRAs and even the rollover business startup 401k as well as traditional 401ks. It looks like we already have some questions here in the queue. So let's take a look at some of those questions and then we'll jump back and cover today's topic, which is Mega Backdoor Roth 401k worth it? Okay, we've got a question here from, let's see. Give me a moment here. Looks like we have a question from Paul. All right, so Paul has a question that reads, what is the minimum self-employment income for a Schedule C filer to max out the mega backdoor for 2024 under 50 years of age? Great question. So first, the overall contribution limit for tax year 2024 is $69,000. And the good news is that if you have not opened a solo 401k plan yet for tax year 2024, then it's not too late to do so. You heard that right. We are in tax year 2025, and you can still open a solo 401k plan here in 2025 so that you can make voluntary after-tax solo 401k contributions for tax year 2024, and then turn around and convert those funds to the Roth Solo 401k or to the Roth IRA. And you can do that if you filed an extension for your business tax return for tax year 2024, as you will have until your business tax return due date, plus timely filed extension to make those contributions and to also perform the Mega Backdoor Roth Solo 401k strategy. Second, the overall contribution limit for tax year 2024 is $69,000. Therefore, you can choose to solely make voluntary after-tax solo 401k contributions for tax year 2024 up to the overall limit of $69,000, provided you have the necessary net self-employment income to justify that contribution. So back to your question here, since your business is taxed as a sole proprietorship, you will have needed to have paid yourself at least $74,246 in Schedule C line 31 wages for tax year 2024 in order to maximize the Mega Backdoor Roth Solo 401k strategy of $69,000 for 2024. That's for someone who's under age 50. If you're over age 50, then you will have needed to have paid yourself at least $82,316 of line 31 Schedule C income to maximize your 2024 Mega Backdoor Roth Solo 401k contribution strategy for a total of $76,500. Good question. All right, let's see what other questions we have. We've got a question here from Jaya. Let's see what it says. Hi, my solo 401k account value is less than $250,000 and I did not do any taxable conversions or distributions. Any documents I need to file my 2024 business and tax returns, showing contributions from employee and employer to solo 401k accounts? How do we know if we contributed anything over the limits? Great question. So contributions to the solo 401k are reported on your personal and or business tax return. So let me provide a link where you can read about how to report contributions on your personal and or business tax return, which is based on the contribution type. Give me a moment here and I'll share that link with you. And this link here to the page on our website does a really good job of breaking down exactly how to report contributions. Let's make sure that link went through here. There it is. So go ahead and take a look at that link there. As far as determining if you over contributed to the plan, you're going to want to take a look at the contribution rules on our website. So let me send that over to you here. So you want to make sure that you stay within the contribution limits. So there's the link to the contribution page. Let me send over a link to our solo 401k contribution calculator, which will help you determine how much you can contribute. You can also submit a support ticket to us if you're a client, and we'll gladly calculate the contribution for you. We'll just need some information that we'll collect from you. But here's the link to our calculator. And let me send over a link to our support page where you can submit a support ticket and provide information so that we can help you calculate that contribution. Give me a moment. Okay, I just went ahead and shared that link with you. Great questions. All right. Go ahead and keep sending over your questions, and we'll pause and answer those questions as they come in. Looks like we got a comment from Paul. Wow, that's great. Only 74,000 of net self-employment income needed to maximize 69,000 for 2024 with timely filed extension. That's exactly right. All right. Let me see if there are any other questions. Looks like we got a follow-up question here from Paul. What happens when I restate my Fidelity prototype plan to my solo 401k? Will I be able to do an in-plan conversion at any time without terminating my new solo 401k? That's exactly right. When you restate your plan from Fidelity Investments to a self-directed solo 401k from my solo 401k financial, which we do on a daily basis, we help clients restate from Fidelity solo 401k to a solo 401k from my solo 401k financial so that you can utilize the Mega Backdoor Roth solo 401k. That's not going to be a taxable event when you move from that Fidelity solo 401k plan to a self-directed solo 401k from my solo 401k financial. And the good thing about that is that we will help you with that restatement of that Fidelity solo 401k to a solo 401k from my solo 401k financial. And let me share a link from our website that talks about that. All right, I just sent over that link. Right there, it talks about restating from an existing Fidelity solo 401k to a Mega Backdoor Roth solo 401k provided by my solo 401k financial. And then when you go ahead and process that Mega Backdoor Roth solo 401k conversion under the plan that we provide, that is not going to close the plan because you're not closing the plan with my solo 401k financial. You're processing a conversion, and then you can always make new contributions the following year and continue to do the Mega Backdoor Roth solo 401k conversion. Of course, when you restate that solo 401k from Fidelity to a self-directed solo 401k from my solo 401k financial to perform the Mega Backdoor Roth solo 401k strategy, if you hold any investments in that existing Fidelity solo 401k, such as equities, you don't have to liquidate those positions because Fidelity Investments will provide what they refer to as non-prototype brokerage accounts for a self-directed solo 401k offered by my solo 401k financial, so that you can then utilize Fidelity Investments for those new brokerage accounts for this solo 401k provided by my solo 401k financial, and will help you to move internally the existing funds and securities in that Fidelity solo 401k to the new brokerage accounts for the self-directed solo 401k from my solo 401k financial. Fidelity will not allow you to continue to use those existing brokerage accounts provided by Fidelity for their solo 401k, but they will provide new brokerage accounts for the self-directed solo 401k offered by my solo 401k financial. And they understand that my solo 401k financial will be responsible for the plan reporting, A. B, that it's the solo 401k from my solo 401k financial that allows for the mega backdoor Roth solo 401k strategy. And C, that my solo 401k financial is the one that will perform the required Form 1099-R reporting to report that mega backdoor Roth solo 401k conversion to the government. All right, great questions. Go ahead and continue to shoot over your questions and we'll address them as they come in. So let's continue with our daily webinar for today, which is my mega backdoor Roth. Is the mega backdoor Roth 401k worth it? So let's jump to the next slide here. Okay, so here's what we are going to cover on this topic today. And again, go ahead and shoot over questions as they come in. They don't have to be specific to today's topic, and we'll answer those questions as they come in. So, first bullet point here: difference between a Roth 401k and a mega backdoor Roth. So, keep in mind that the self-directed solo 401k plan allows for various contribution types, such as pre-tax contributions, Roth contributions, and voluntary after-tax contributions. So it's just one solo 401k plan with these different sources that can be allocated, these different contribution sources that can be allocated to the self-directed solo 401k plan. When you make a Roth solo 401k contribution, you can make that as an employee Roth solo 401k contribution. You can also make it as an employer Roth solo 401k contribution. If you make it as an employee Roth solo 401k contribution, then if we're talking about tax year 2025 contribution figures, then you can contribute $23,500 as an employee Roth solo 401k contribution. If you're making an employer Roth solo 401k contribution, then you can contribute either 20% of your net self-employment income if you're a sole proprietorship or a partnership. If you're self-employed business is taxed as an S corporation or a C corporation, then it's 25% of your W-2 wages that can be made as an employer Roth solo 401k contribution. Then you have voluntary after-tax solo 401k contributions, which are part of that mega backdoor Roth solo 401k strategy. Now, the voluntary after-tax solo 401k contributions, those are calculated on a dollar for dollar basis. For example, let's say your self-employed business is an LLC taxed as an S corporation. And let's say that you pay yourself a total of $70,000 of W-2 wages for tax year 2025. Because the voluntary after-tax solo 401k contributions are dollar for dollar, you can make a voluntary after-tax solo 401k contribution amount of $70,000 based on that $70,000 of W-2 wages that you paid yourself. Now, here's another interesting factor. The solo 401k allows for catch-up contributions. So if you are over age 50 and sticking with that LLC tax as an S corp self-employed business example, if you pay yourself $77,500 of W-2 wages for tax year 2025, then you're going to be able to treat that first $70,000 as a voluntary after-tax solo 401k contribution. And then you can turn around and convert it to the Roth solo 401k or the Roth IRA. And then the catch-up contribution amount of $7,500 you can make that contribution as a Roth solo 401k employee contribution, resulting in getting a total of $77,500 in Roth solo 401k funds into your plan, consisting of that $70,000 voluntary after-tax solo 401k contribution that you then convert to the Roth solo 401k, plus that $7,500 catch-up contribution that you make to the Roth solo 401k. So you notice how I did not say that you can put that catch-up contribution directly into the voluntary after-tax solo 401k. And that's because the regulations do not allow for the catch-up contribution of $7,500 to be contributed to the voluntary after-tax solo 401k bucket. But that's no problem because you can go ahead and contribute it directly to the Roth solo 401k bucket. And you still end up with contributing a total of $77,500 in contributions for tax year 2025. Now, another example, using the same example as above regarding how it's an LLC taxes an S corporation. There's also this super catch-up contribution for tax year 2025. That amount is $11,250. And it only applies for those who are a certain age, specifically age 60, 61, 62, or 63 in tax year 2025. So for those that fall within that age range in 2025, you're going to be able to make an $11,250 super catch-up contribution instead of the $7,000 500 catch-up contribution. So you can't do both, but you can contribute a higher amount of $11,250 super catch-up contribution if you're age 60, 61, 62, or 63 in tax year 2025. So therefore, if you pay yourself at least $81,250 in W-2 wages from that self-employed S corporation for tax year 2025, you're going to be able to contribute that first $70,000 to the voluntary after-tax solo 401k bucket, and then immediately convert that to the Roth solo 401k. Then that catch-up amount of $11,250 cannot be contributed to the voluntary after-tax solo 401k. However, you can contribute that amount directly into the Roth solo 401k bucket, aka bank or brokerage account holding account, under that solo 401k, resulting in $81,250 in Roth solo 401k contributions for tax year 2025. So talk about really supercharging your retirement account on a Roth solo 401k basis by utilizing that voluntary after-tax solo 401k bucket as part of the Mega Backdoor Roth solo 401k strategy. All right, looks like we've got some more questions here. Let's take a look at those, and then we'll continue with today's topic, which is Mega Backdoor Roth solo 401k worth it? As always, please like today's video. Please subscribe to our channel so you receive notifications when we go live. We typically go live at least once a day, oftentimes twice a day. For example, we'll be live again today in a few hours. So you will receive notifications when we go live. Okay, let's take a look at another question here. So, got a question here from Paul. If I roll over my entire solo 401k to my solo 401k balance, then choose to roll over a portion of those assets to a rollover IRA to another brokerage, and I leave my plan assets under 250,000, will I not be subject to the 5500 form requirements? My new solo 401k would then have less than 250 as I have moved the majority of assets to a rollover IRA at a different institution. Good question. So there's an IRS regulation that's been put in place for strategies like this. Essentially, if you transfer any funds out of the solo 401k plan to an IRA during the year, so for example, let's say here in 2025, The value of your solo 401k plan is over $250,000 during the year, but you then process a transfer of solo 401k funds to an IRA here in 2025. Well, you're going to have to add that amount that you transferred out of the solo 401k to an IRA to the ending value of the plan as of December 31st of 2025, which means that, yes, you're going to have to file a Form 5500 easy for tax year 2025 because the value of your solo 401k plan as of the end of the year, when you take it into account, all the amounts transferred out of the plan during 2025 exceeded the market value of $250,000. So in your case, yes, you're going to have to file at least one Form 5500 easy for tax year 2025, and that's going to be due by July 31st of next year. However, next year for 2026 plan year, if the market value of the plan is less than 250,000 by December 31st of 2026, assuming you don't process any transfers in or out that when added together would exceed the $250,000 fair market value, then you would not have to file a Form 5500 easy for tax year 2026, which would be due by July 31st of 2027. So great question. So it looks like you are going to have to file a Form 5500 easy for at least 1 year, and that's tax year 2025. There's a similar rule put in place by the government for required minimum distributions as well, but that's a whole other topic. Okay, thanks for your questions. It looks like we have another question here from Jaya. If my W-2 wages are only $30,000, can I still contribute a full $70,000 to the solo 401k accounts? I'm glad you asked that question. The answer is no. The rule is that you cannot contribute more than you make to the solo 401k plan, and that you can now go over the overall contribution limit, which for someone under age 50 for tax year 2025 is $70,000. So if you only make $30,000 of W-2 wages from your self-employed business for tax year 2025, and you want to treat the entire $30,000 as a voluntary after-tax solo 401k contribution, then that would be the maximum that you could contribute. That is $30,000. What is more, you wouldn't be able to make any other contributions like pre-tax employer contributions or employee contributions, because you would have exhausted the total $30,000 in W-2 wages that you paid yourself by making it into the voluntary after-tax solo 401k bucket. So in short, you cannot contribute more than you make. So in order for you to contribute a full $70,000 overall limit to the solo 401k plan for tax year 2025, since your business is taxed as an S corp, you're going to have to pay yourself at least $70,000. And if you pay yourself at least $70,000 of W-2 wages, then you can contribute that entire $70,000 contribution to the voluntary after-tax solo 401k, and then turn around and convert it to the Roth solo 401k or the Roth IRA. We'll talk later about whether you should convert to the Roth solo 401k or to the Roth IRA when utilizing the Mega Backdoor Roth 401k strategy. Okay, good question. Looks like we don't have any other questions for now. Let's continue with our discussing today's topic, which is Mega Backdoor Roth 401k worth it? All right, let's talk about the second bullet, how the Mega Backdoor Roth 401k actually works. And let me pull up another slide so that we can go over that. So we just talked about how it works from a contribution perspective. We gave some good examples there. Let's talk about the other requirements for it. And I thought I had that slide here. Give me a moment here while I pull up that slide here. One moment here. Again, go ahead and shoot over any questions you have during today's daily webinar. It doesn't have to be specific to today's topic. In the meantime, I'm going to try to find that darn slide. I may have to share my screen here. Let's see here. Here we go. Let me share my screen and we'll talk about it. Here. So let's talk about how the Mega Backdoor Roth solo 401k strategy actually works. I can. One moment here. Okay, here we are. So, with respect to how the Mega Backdoor Roth solo 401k strategy actually works, well, first, you want to make sure that, as I mentioned earlier, that you open a self-directed solo 401k plan with a provider that allows for the Mega Backdoor Roth solo 401k strategy. My solo 401k financial does provide a plan that allows for the Mega Backdoor Roth solo 401k strategy, but traditional solo 401k providers like Fidelity and Charles Schwab, for example, do not allow for it. So that's number one. Make sure you open the self-directed solo 401k with the correct solo 401k plan provider. When you open the solo 401k plan with my solo 401k financial, we're going to help you open up separate holding accounts under that solo 401k plan to hold the various solo 401k contribution sources. So, for example, it's going to be just one plan if we're talking about just one participant in the plan. So the solo 401k plan would be sponsored by the self-employed business, and that plan is going to have three separate holding accounts. Let's say you utilize Fidelity Investments for the brokerage accounts for the solo 401k provided by my solo 401k financial. And let's say it's only one participant in the plan. So the plan would be sponsored by your self-employed business. You would then have three separate brokerage accounts under that one plan. The first one would be the pre-tax bucket to hold the pre-tax solo 401k contributions, which would be used if you want to transfer IRAs, former employer plans to the solo 401k, or for making pre-tax solo 401k contributions. The second bucket, aka a bank account or brokerage account under that solo 401k plan, would be used to make Roth solo 401k contributions and also to hold transfers from former employer Roth 401ks, for example. Keep in mind, a Roth IRA can never be transferred to a Roth solo 401k. That's a Roth IRA regulation. And then the third bucket is the voluntary after-tax solo 401k holding account, aka bank or brokerage account. Now, this slide here also provides an example of a two-participant plan. Let's say both spouses are self-employed in the same business. Let's say they're self-employed under an LLC, taxes and S corporation, and they both receive W-2 wages. Then it's just one solo 401k plan for both spouses. And that's because they're both working under the same business. So it's not two separate solo 401k plans, it's one solo 401k plan. Be aware there are other solo 401k providers out there that try to be slick, or I like to say sneaky, and they try to charge you for two solo 401k plans for a business where both spouses work in the same business. So what they do to justify charging you double setup fees is they will open up two separate solo 401k plans, one for each spouse, which is number one, that's not allowed by the IRS regulations. And number two, they're trying to take you for a ride by charging you double fees. And that's going to complicate things because now they're probably going to try to say, hey, you're not going to have to file Form 5500 easy if you open up two plans. Well, that's incorrect. Number one, that's not allowed to open up two separate plans under the same self-employed business. It's similar to if you work for, let's say you work for the Home Depot. The Home Depot provides one 401k plan that's available to all of their employees. They each have separate participant accounts under the plan. They don't open up multiple Amazon 401k plans. Same concept with the solo 401k plan. It's one business that sponsors the plan. So if you have two spouses working under that same LLC, for example, it's only one solo 401k plan that you would open, and you would each have separate holding accounts under that one solo 401k plan because you are required to separately track each participant's funds and contribution source. So this slide here is an example of a solo 401k plan with 6 holding accounts because there are 2 participants, and the plan allows for all these contribution types. Now, you don't have to utilize all these contribution buckets right away. One year you may decide to make just voluntary after-tax contributions, or you may decide to just make pre-tax contributions, and then the following year you want to utilize the other bucket. That's fine. The plan is already built to allow for all these contribution types. So that's number one. It's first you need to make sure you choose a solo 401k provider that will open up a self-directed solo 401k for you that allows for the mega backdoor Roth solo 401k strategy, and then make sure that they are well versed in the regulations and that they don't try to take you for a ride by trying to charge you double fees, double setup fees. And let me share my screen again here. I don't know what happened there. Share my screen. Give me a moment here, please. Okay, there it is. So let's go back to the prior page. Okay, so we're going over the steps to utilize the mega backdoor Roth solo 401k strategy. We talked about one, you got to make sure you pick the right solo 401k provider that allows for the mega backdoor Roth solo 401k strategy. Then you have to open up those various holding accounts under that solo 401k to hold the contributions, including that mega backdoor Roth strategy. So when you see the words designated account, that's referring to the various holding accounts under that solo 401k plan to hold those various solo 401k contribution sources. So in this case, we're talking about the mega backdoor Roth solo 401k voluntary after tax holding account, brokerage account, or bank account. So that's the account, the holding account under the solo 401k plan that you would make that contribution into. It's called the voluntary after-tax solo 401k holding account. And then you make the contribution into that account. And again, for tax year 2025, if you have enough net self-employment income from your self-employed business, you can contribute as much as $70,000 as a voluntary after-tax solo 401k contribution. So that would go into that voluntary after-tax solo 401k account. Then you need to convert. You need to move the funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket or to a Roth IRA. You get to choose. And we're going to discuss in a moment whether you should convert to the Roth IRA or the Roth solo 401k. Once you've converted those funds to the applicable bucket, you need to complete our online conversion form, because we need to issue a Form 1099-R to the IRS to report that conversion. And you want to convert those funds right away so that there are no gains. The basis will not be taxable, but any gains that you convert directly to the Roth solo 401k or the Roth IRA will be taxable. So you want to convert right away so that there are minimal gains when that conversion is processed. So once you've converted those funds to the Roth solo 401k or the Roth IRA, if you are a client of my solo 401k financial, we'll issue that Form 1099-R to report that conversion to the IRS as long as you timely complete that conversion form. Once you complete that conversion form, and let me show you on our website where that form is, you would go to our forms tab of our website. That's where you can find that form. So here's the forms tab. And if you scroll down, here's the category of end plan conversion form. If you're converting voluntary after-tax solo 401k funds to the Roth solo 401k, then you would complete this form here. If you are converting them to the Roth IRA instead, then you would complete this form here. And again, that's completed after you move the funds from the voluntary after-tax solo 401k to the Roth solo 401k or the Roth IRA so that you know exactly how much you converted. And for clients of my solo 401k financial, we don't charge additional fees to issue that Form 1099-R, and we'll issue that to the IRS and to you, as long as you timely request it. Okay, and then the last step in the Mega Backdoor Roth Solo 401k strategy is where we would issue that Form 1099-R, a copy sent to you and a copy to the IRS. Now, the question we oftentimes get is, should I convert my voluntary after-tax solo 401k contributions to a Roth IRA, or should I convert it to the Roth solo 401k? So we put together this graph here or image on our website to help you understand and make an informed decision. I mean, at the end of the day, you really can't go wrong whether you convert to the Roth IRA or the Roth Solo 401k. Now, it used to be that most clients wanted to convert to the Roth IRA because Roth Solo 401k plans used to be subject to required minimum distributions. A required minimum distribution is where the government wants to start collecting tax revenue or forcing you to take distributions from your retirement account. Well, Roth IRAs have never been subject to required minimum distributions. That was not the case before for Roth Solo 401k plans. However, with the passage of the Secure Act 2.0 a few years ago, now, just like Roth IRAs, Roth Solo 401k funds are no longer subject to required minimum distributions. And the required minimum distribution age is age 73. But again, the Roth Solo 401k, just like the Roth IRA, is no longer subject to required minimum distributions. So as a result, we tend to see that most clients will convert the voluntary after-tax solo 401k to the Roth solo 401k instead. Another reason why we don't see too many clients converting to the Roth IRA anymore, but rather to the Roth solo 401k is because a Roth IRA does not allow for participant loans, whereas a Roth solo 401k allows for participant loans. And that's where you can borrow 50% of your total Roth solo 401k balance up to $50,000, and you can use the proceeds for any purpose. And then when you pay back that Roth solo 401k, guess what? You pay it back with principal and interest. So that interest goes back into your Roth solo 401k. So you're basically indirectly getting more Roth solo 401k money into your Roth solo 401k by borrowing from your Roth solo 401k. And it's going to grow tax-free. Another reason why we see clients convert to the Roth Solo 401k instead of the Roth IRA is because our Solo 401k allows for investing in alternative investments, whether it's cryptocurrency, precious metals, private equity, but also real estate. Many of our clients like to invest in rental real estate, and many of them utilize what's referred to as a non-recourse loan or debt financing, which is a loan that's made to the Roth Solo 401k so that you can get more funds into the Roth Solo 401k indirectly for investing in rental properties. Well, when you do that through a Roth Solo 401k that has utilized debt financing or a non-recourse loan, it does not trigger a tax known as unrelated debt finance income tax, which does apply to Roth IRAs, specifically self-directed Roth IRAs that utilize the same strategy when investing in real estate. And that tax is 38%. while the first $1,000 is exempt from that unrelated debt finance income tax, the remaining amount is subject to that 38% tax rate. For example, let's say you bought a rental property through your self-directed Roth IRA. You utilize debt financing, so a non-recourse loan. Let's say that you receive the Roth IRA received $10,000 in rental income for the year. Well, the first $1,000 is not subject to that unrelated debt finance income tax, but the other $9,000 is. So the self-directed Roth IRA is going to have to pay 38% of $9,000 in unrelated debt finance income tax. So again, that tax does not apply to self-directed Roth solo 401k plans that invest in rental property that utilize debt financing. All right, so looks like we have some more questions here. Let's take a look at some of those and then we'll continue with today's topic, which is Mega Backdoor Roth 401k worth it? And then we'll pick back up where we left off. So we've got a question here from Paul here, or a comment. Great. Confirming my solo 401k plan allows in-plan rollout of assets to move plan assets out of the plan, which Fidelity prototype plans do not allow. So yes, keep in mind that when you transfer funds out of the solo 401k plan, and we're talking here about pre-tax solo 401k funds specifically, you have to meet a triggering event. You have to be at least age 59 and a half or no longer self-employed. And if you're no longer self-employed, well, you're gonna have to close the plan down. You can also transfer any funds from the solo 401k that were transferred into the plan from a traditional IRA or former employer plan. So funds that were transferred into the plan from IRAs or former employer plans can always be transferred out of the solo 401k plan. Obviously, those same rules do not apply to the Mega Backdoor Roth solo 401k strategy because that entails making a voluntary after-tax solo 401k contribution that can then get converted to the Roth IRA or the Roth solo 401k plan. All right, let's see here. Looks like we got another question here from Paul. Well, the Form 1099-R have a box 2 code of G in your example of the Mega Backdoor after-tax backdoor Roth IRA. Or will this be a form marked as a taxable with distribution 1 or 2? Great question. So Mega Backdoor Roth solo 401k conversions are always reported on a Form 1099-R. And box 1 of the Form 1099-R, you list the total amount converted. Box 2A of the Form 1099-R, you list the taxable amount, if any. And then in box 7, you list a code G, which communicates to the IRS that it was a conversion to the Roth solo 401k or the Roth IRA. And there's also a box 5 where you report the total amount contributed as a voluntary after-tax solo 401k contribution. So all that information communicates to the IRS that it was a Mega Backdoor Roth strategy that was reported as a conversion. Good question. All right, let's continue here with our daily webinar topic. Go ahead and shoot over questions as I mentioned, or type them over, and we'll pause and answer those questions as they come in, and they don't have to be specific to today's topic. Let's see here. We've got a question here of, give me a moment. Okay, there are no questions there. So let me share my slides here and we'll continue. Let's talk about the next bullet point here. Who benefits the most and who should avoid it? Well, we find that high income earners benefit the most from the Mega Backdoor Roth solo 401k strategy because they typically have the necessary self-employment income to utilize the Mega Backdoor Roth 401k strategy up to the overall limit, which is $70,000 for tax year 2025. So we get a lot of doctor clients and professionals like attorneys that utilize the Mega Backdoor Roth Solo 401k strategy. Of course, anyone can utilize it. Keep in mind that when you make voluntary after-tax solo 401k contributions, it does not reduce your taxable income for the year, but the trade-off is that when you convert that to the Roth Solo 401k, it's not going to be a taxable conversion and it's going to grow tax-free. So it's tax-free growth. So you're also going to benefit the most if you think that the tax rates are going to increase. The federal tax rates or even state tax rates will increase in future years. And many in the industry say that, yeah, taxes are probably going to have to go up eventually. So those who should avoid it would be those who are trying to get a tax deduction for the year by making contributions to the solo 401k. If you're trying to get a tax deduction for the year, then you would make pre-tax solo 401k contributions. Keep in mind, you can make pre-tax solo 401k contributions and also some voluntary after-tax solo 401k contributions, as long as you don't go over that overall limit. So, and also those who think that the government is not going to raise taxes in the future, or if you don't think you're going to be in a higher tax bracket in the future, then it may not make sense to utilize the Mega Backdoor Roth Solo 401k strategy, or to even make Roth 401k contributions for that matter. Okay, now as far as the rules that you must follow to avoid penalties, the hidden rules, well, one, make sure that the plan that you open, the solo 401k plan that you open, allows for the Mega Backdoor Roth Solo 401k strategy, because not all solo 401k plans allow for it. Again, a plan for my solo 401k financial does. We automatically draft our plan to allow for the Mega Backdoor Roth Solo 401k strategy. So that's number one. Number two, making sure that you report those contributions, if applicable, on your tax return. It depends on your self-employed entity type as to whether or not you need to report those voluntary after-tax solo 401k contributions, even though it's not a taxable event. Also, make sure that the conversion is reported on a Form 1099-R. Even though it's not going to be taxable if there are no gains, it still needs to be reported to the IRS on a Form 1099-R. And lastly, make sure that you don't contribute more than you're allowed to, because again, you can now go over that overall limit of $70,000, for example, for tax year 2025 as a contribution. And also you can now contribute more than you make. So if you're trying to contribute up to the overall limit of $70,000 as a voluntary after-tax solo 401k contribution, make sure you have enough net self-employment income to justify that contribution. All right. It looks like we've come to the end of our session. We appreciate you asking questions today. We'll be live again tomorrow. It looks like we'll be live again here in a couple hours. Until then, have a good rest of the day.